So when a big geopolitical crisis hits, the old playbook is pretty simple, right? You sell your stocks, you buy some gold. But what happens when you throw an asset like Bitcoin into that mix? You know, the one everyone calls digital gold. Well, the wild events of early 2026 put that whole idea to the ultimate test. So let's dig into the data and see what really happened when things got serious.
And wow, did it all happen fast. On February 28, 2026, the world wakes up to news of these coordinated strikes on Iran. Retaliation was, well, immediate. Iran hit energy infrastructure, and then they did something huge. They closed the Strait of Hormuz. We're talking about the choke point for something like 20% of the world's entire oil supply. Just like that, global markets were sent into a total tailspin.
Okay, so at first, in those initial 24 hours, the markets did exactly what you'd expect. It was straight out of the textbook. Investors made a classic flight to safety. Gold jumped about 2%. And at the same time, all the riskier stuff sold off, hard. And Bitcoin, it was right there with them, plunging 8.5%. For a hot minute, it looked like that whole digital gold narrative had just, crumbled at the very first sign of real trouble.
But then, things got weird. Really weird. Fast forward just 2 weeks, and the entire picture had completely flipped on its head. The conflict is still going on, but Bitcoin, it didn't just bounce back, it roared back, surging more than 20% from its low point. And what about gold, the classic safe haven? It was actually down 3.5%. Even the stock market was still in the red. The knee-jerk reaction told one story, but what happened next told a totally different one.
So yeah, that is the big question, right? What in the world was going on under the surface to cause such a massive, dramatic turnaround? How did the asset that's supposed to be risky end up outperforming everything, including the ultimate safe haven?
Well, it turns out the answer wasn't really about the conflict itself, but all the crazy stuff that happened because of it. It was like a macroeconomic chain reaction. So step one, closing that strait caused a massive oil shock. Prices just blasted past $100 a barrel. Then step two, that energy spike immediately brought back all these fears of sticky, persistent inflation. And this is the big one, step three. Central banks like the Fed were suddenly trapped. Any hope that they were going to cut interest rates just evaporated. You can't cut rates when you're trying to fight a new inflation fire.
And that right there, that third step, is the absolute key to understanding what went wrong for gold. This quote from a Commerzbank analyst just nails it. High interest rates are basically kryptonite for gold. Think about it. Gold just sits there. It doesn't pay you any interest. So when rates are high elsewhere, the opportunity cost, what you're giving up to hold that gold, it just becomes massive. The war created an inflation problem that kept rates high, and that, ironically, is what killed the gold rally.
All right, so that kind of explains the gold situation, but it doesn't explain Bitcoin's incredible surge. To get that piece of the puzzle, we have to look at the big money, the institutional investors. They had only recently gotten easy access to Bitcoin through all those new ETFs, the stock-like products that hold Bitcoin for them. So were they panicking and selling with everyone else, or were they seeing something different?
Now, if you were just scanning the headlines, you'd think it was total panic. On one really crazy day, the news was all about this massive $171 million outflow from the Bitcoin ETFs. It looked bad. It looked like a clear signal that the big guys were running for the exit.
But, and this is a huge but, context is everything. That big scary number, $171 million, it was actually less than 0.35% of the total money held in those funds. So what looked like this massive fire sale was actually, well, it was barely a drop in the bucket. It was probably just a few large players doing some routine rebalancing. It was not the big story everyone made it out to be.
Because here's the kicker. When you zoom out and look at the entire month of March, while all this chaos was happening, there wasn't a net outflow at all. In fact, it was the opposite. There was a net inflow of $2.5 billion. So despite all the fear, despite the volatility, the institutions, they weren't selling, they were buying, they were accumulating.
And Eric Balchunas over at Bloomberg, he put this into perfect perspective. He pointed out that when gold took a similar dive about a decade ago, a full third of its ETF investors just bailed. They got out. By contrast, Bitcoin's new institutional base showed what he called incredible fortitude. They held on. They even bought more. That tells you they're in this for the long haul. This wasn't just a trade.
So what's the big takeaway here? This whole crisis basically blew up that simple digital gold story. It proved pretty decisively that Bitcoin's identity in the global financial system is way, way more complicated than that.
It turns out Bitcoin is kind of playing three different roles at once.
On one hand, yes, in that initial knee-jerk 24-hour panic, it acts like a risk asset. It's sold off. But on the other hand, it's now clearly becoming an institutional holding, where the big players are using that very volatility to build up their long-term positions. And then there's this third, really powerful role, a tool for capital flight. Data from the blockchain showed that within 48 hours of the strikes, Bitcoin moving from Iranian exchanges into private wallets surged, get this, 700%. For people actually on the ground, it was an escape hatch.
So you've got this one asset that's part risk on gamble, part long-term institutional bet, and part escape hatch for people in a crisis, all at the exact same time. This conflict didn't give us a simple answer. Instead, it showed us a much deeper, more complex truth about what Bitcoin is. And it leaves us with a huge question going forward. As the world gets more tense, which one of these identities is going to matter the most?